and welcome back everybody to the channel. Here is again the lecture on inheritance tax. We are in chapter 2, where I want to give you an introduction to German inheritance tax law so that you can have a good idea of how an inheritance tax law, at least in one country, works. So for today, we are going to speak about the rest of the most important rules on the tax base, and we'll also talk a bit about the tax rates. So, in the last video, I gave you an overview about how the tax base is computed so that the enrichment of the acquirer counts that everything which is taken over will be valued according usually to the market value or to specific valuation rules, and that liabilities are deducted, and then there is a remaining net amount. And with that we are going to go on, because with that remaining amount, well, there will also be some personal allowances which we have to take into account. Now, when it comes to these personal allowances, so amounts which you can inherit free of inheritance tax or get as a gift free of tax, they depend on the relationship between the people involved. If donations or inheritances are given to or made by close family members, then the tax rates are lower than if you give money or something like that to completely unrelated persons. So in order to take that into account, the taxpayers are distinguished or classified or attributed to different tax classes here. So tax class 1 is the closest family members. Let's say spouse, children, children of children, and things like that. Class 2 is roughly said the wider range of the family, so the more distant relatives, let's say nephews and people like that. And class 3 is all others, so unrelated persons, or let's say a cousin of second degree or so. Now, in detail, when you want to have a look at the tax clauses, the best thing is, as always with legal stuff, just to take the tax acts and have a look. Paragraph 15.1 is what gives you the necessary overview. Here it is. So here we see that according to the personal relationship between the acquirer and the deceased and the donor, the following tax clauses are distinguished. Number 1, husband, wife, or same-sex partner, so-called life partner, is all tax clause 1. Children and stepchildren. You know, stepchildren are not your own children, but the children of your spouse from another relationship. The descendants of your children or the stepchildren, so your grandchildren and great-grandchildren, and how deep the chain of generations will ever be. Parents and ancestors. Ancestors is grandparents, grandmothers. No, grandmothers are grandparents, but grandparents, great-grandparents, and whatever might be alive, in cases where somebody dies. Because then if you die childless and your parents are still alive, we have heard that already, then your property goes back to your parents, and that is then closest relationship which probably exists. Tax clause 2, parents and ancestors, so parents of parents and so on, in cases where they do not belong to tax clause 1. So if you make donations or gifts to your parents during lifetime, then that will be tax clause 2. Brothers and sisters are tax clause 2. The descendants in the first degree of brothers and sisters, that's nicely put. The descendants are the children, and the children of the children and all the others. And in the first degree is only the children. Step parents, well, children-in-law, so son-in-law or daughter-in-law, who, if you are not familiar with the term son-in-law, that's simply the husband of the daughter, and daughter-in-law is simply the spouse, the wife of your son. Parents-in-law is the same, the other way around. And then, surprising, the law accepts that your divorced husband, divorced wife, or divorced life partner is also still probably one of your closer family members, because it seems to be that in relatively high amounts of cases, it happens that after a while, divorced partners still are very friendly to each other, or that a certain rest of the relationship remains, so that sometimes the one inherits from the other. So that's text clause 2, and text clause 3 is the most simple one to memorize, because text clause 3 is everything else or everyone else. Good. Now, let's have a closer look to the general free allowances. These are the free allowances which are granted under all circumstances, no conditions, if one of the text classes apply, and depending on the text classes and the personal relationships. Here you have them in paragraph 60, and there is additionally also an additional allowance for alimentation purposes in paragraph 17, which can be claimed but only under certain circumstances by surviving spouses or children, and it will be lowered or reduced by certain amounts to under certain circumstances only. So that's a bit complicated. 16, the general free allowances, is easy. Here you see them. In the case of unlimited tax liability, the following amounts remain tax-free. For husband, wife, and life partner, 500,000. For children, as mentioned in text clause 1, number 1, that is children who are still alive, 400,000. And for children of deceased children, so grandchildren, if the intermediate generation has already died, 400,000. For all other persons of text clause 1, so for example, for children of a child who is still alive, 100,000. For persons of text clause 2, 20,000 free allowance, and text clause 3 also 20,000. Now you might ask yourself, why, if it's 20,000 in text clause 2 and 3, why we make the distinction? Well, later when it comes to the tax rates, the distinction between 2 and 3 as text clause still will play a role. Good. So here we have that overview, and that would mean if a father gives to his daughter an amount of 600,000 as a gift, we have first to determine the tax clause. It's text clause 1 because she is a child. 15.1, text clause 1, number 2, children and stepchildren are text clause 1, so she is text clause 1. So she gets the personal allowance of 400,000 under paragraph 16.1, number 2. I can show it to you again. Here it is. Here you see it. Second entry, 400,000 for children. Okay, so here we are again. So taxable amount is only what remains, 200,000. For 200,000, we will later have to look up the tax rate and the tax amount. You can also imagine the following case. Mother M dies and leaves behind daughter and son who both inherit half of mother's estate. So mother leaves behind a total amount of 2,500,399 euro. Now each of the two heirs inherits half of that. That's 1,250,199.50. Each of the two heirs is tax clause 1, children. So the personal allowance is 400,000 in each of the two cases. So the taxable amount for both is the 1,250, 199.50 minus the 400,000 free allowance, 850, 199.50. Now we round that down to even 100, so 850, 100, and that would be the basis for the tax calculation if nothing else comes on top. Another example, let's imagine there is someone here, indeed it's someone, and someone leaves his property to three heirs with equal shares. 1/3 to his granddaughter, daughter of a deceased son, 1/3 to a nephew, and 1/3 to his girlfriend with whom he lived together for the last 20 years but whom he never married. Now, what happens here? Well, the estate shall have a purpose of 1,957,824, and the granddaughter is tax class 1 because she is the daughter of a child who has already died. The nephew is tax class 2. Descendants of brothers and sisters in the first degree are nephews and nieces. The girlfriend is surprisingly no family member at all. She might have been the closest friend and the closest relation ever, but legally there is no relationship because they never married. So unfortunately, she is tax class 3. Now, before the application of personal allowances, all the three, not both, inherit 652, 608. The personal allowance for the granddaughter is now 400,000, so the remaining taxable amount is 252,608, to be rounded down to 252,600. The personal allowance for the nephew is 20,000, so 632,608 remain to be rounded down to 632,600. And for the girlfriend, also the same personal allowance under tax class 3 now, so same amount remains, again to be rounded down to the same amount. And now these free allowances, these general free allowances always apply under the condition that we have unlimited tax liability. Now, in case of limited tax liability, where not all the transfers of property worldwide are taxed, one has a rule that in these cases, these free allowances are granted to, but are granted only according to the percentage of the worldwide transfer of property which is indeed taxed under German limited tax liability. So if limited tax liability covers 20% of what you inherit, you will also get 20% of the free allowance, which you would get if you were unlimited tax liable. So to illustrate that, father and son shall both live abroad. F gives to S a donation of 2 million in form of several assets, and now a piece of land in Germany, 300,000, is also included in these 2 million. And it shall not be tax-free, just to add that on top. As now the limited tax liability covers only the house in Germany, the limited tax liability covers only 300,000 out of 2 million, so only 15% of the worldwide property transfer. So accordingly, only 15% of the personal allowance for a parent-child transfer is granted, so 400,000 times 15%, only 60,000. Example 2. Imagine there are mother M and daughter D. They both live abroad, so no way or no reason why unlimited tax liability should apply. Indeed, it does not. M gives to D a house in Germany, and we now explicitly say this house will not be tax-free or taxed in a reduced way. Also, the tax value of that house is 500,000 euro. Now, within the last 10 years, M has already given to D several donations and gifts with a value of 4.5 million altogether. Included in these former transfers was another house in Germany, taxable with a value of 300,000. Now, what does this mean for the free allowance? Well, under German inheritance tax law, Usually, when it comes to calculate the tax base, we are going to speak about that in detail later. You add up all the taxable transfers within the last 10 years. So if you do that here, between mother and daughter, there was a flow of money of 5 million euro. Now the amounts which were subject to limited tax liability in Germany out of that 5 million were 800,000. That is 16%. Now, if 16% were taxed, then also 16% of the relevant personal allowance will be granted. So 400,000, 16% out of it. I think 64,000 or so. I hope so. I just calculated that without a calculator, just relying on my own brain. Might be wrong. But you see the principle here. So according to the percentage which gets taxed here in Germany, according to that percentage, you get also the appropriate share in the free allowance, which somebody with unlimited tax liability would be able to profit from. Now, there is, for certain cases, also an additional allowance, the alimentation allowance. In order to understand what it's meant for, you need to see specific constellations. It might be that a family depends mostly on the income of one of the spouses. Might be a traditional family model also. Now imagine that spouse dies, and now the surviving spouse sits at home with the children. Surviving spouse has a far lower income, perhaps, or no income, and now they might need the property of the deceased in order to finance the cost of living in the future. So it would probably be a very bad taste, or show a very bad taste, to tax away that money and later force them to ask for welfare payments. So for this reason, the law grants to such people a free allowance for future needs if they need that for financial support. By the way, with the generous free allowance of today, that is not always as necessary as in former times. But in the very early times of the Inheritance Tax Act in Germany, there were very small general allowances, and so these alimentation allowances could really play a role, and they were later never abolished. So the idea is, if somebody dies and leaves heirs in a situation where they need the inherited property to finance their life in the future, that is probably a very bad taste to tax that away, so they get granted an allowance which, according to the ideas of the legislator when these rules were written, were sufficient, or grants sufficient money to be sustained for the next decades. That is then regulated in paragraph 17. Now, sometimes it might happen that when your partner dies, or when your father or mother dies, that you immediately afterwards then get a claim to financial support from some institution, or you get an additional payment, a monthly financial support from father's or mother's former employer. Many firms have in their pension schemes also clauses that if an employee dies, that then the family members can claim financial support from the employer, a small pension, just to give them necessary financial support. In all these cases where these claims are not subject to inheritance tax as a right inherited from the dead employee or from the dead member of the family, then the law says, okay, these people need a lower free allowance or even no free allowance, because their need to finance their life is already partly or completely financed by that additional financial support. So we can reduce the free allowances for alimentation needs in these cases in accordance with what they get from these additional pension payments. So the rule is that if you have such claims against an insurance, no, not against an insurance company, but against the social security system or against your former employer, the free allowances for alimentation will be reduced accordingly. That means by the present value of these claims for the future. Imagine how it might work. Father dies, leaves behind a child. The child is still a minor, so child is still in need of financial support by parents. Now parent with money is gone, so that child would still have had needed father's financial support until it was grown up and will be fully educated to qualified for a job. So that child would have been entitled to father's support, and now, since father is gone, that child gets an additional allowance for alimentation to leave some additional capital in the hands of that child to be able to live from that, quasi as a replacement for the future financial support which father would have given until child would have been grown up. Now, when that child now gets regular financial support, a claim to that from the social security system, which sometimes can be given to minors, or if there is a financial support regularly paid out by father's former employer until the child is grown up, then the allowance will be reduced accordingly by the present value. Here you can see the legal text and gain an own impression. In addition to the allowance under paragraph 16(1) number 1, the surviving husband, wife or life partner gets a special allowance for alimentation of 256,000 euro. That was originally 500,000 Deutsche Mark, and it has been rounded up when the currency change to the euro came. This allowance is reduced for husbands, wife, and life partners who, because of the death of their partner, have claims to rents and similar revenues. Rents here meant in the way of pensions, similar revenues which do not underlie the inheritance tax. Then that will be reduced. Those claims are then valued with the present value, which has to be determined according to the rules of paragraph 14 of the valuation law, the Bewertungsgesetz. So husbands, wives surviving each other get a relatively high alimentation allowance, which makes sense because sometimes the surviving spouse needs the capital to live from it for the rest of one's life. And children, here's the situation is different. Children would normally only need financial support of their parents till they are grown up and educated enough to take a job. So here the amount which can be reserved for their financial support in an untaxed way is lower, because first, a child has usually lower needs, and second, there is a shorter time limitation. So if some child inherits something on grounds of death, then there will be free allowances here which are phased out. If you are already 20 years but not yet 27, only 10,300 euro are left for you as free allowance. And again, there is then a rule: if there is a claim to additional financial support regularly in the future, then that free allowance will be lowered by the present value of these claims, because otherwise people who get such a pension would be far better off than other people. They would basically not need such a free allowance, because instead of capital, which they have to use up to finance their living until they are, let's say, 27, they would get regular and constant financial support month by month, so they would not be in much need of capital, which they need to use up. Again, in cases of limited tax liability, the additional allowance for alimentation is granted too, but then the German fiscal authorities claim, or here the law claims, that this is only done if the states where the people involved live grant an exchange of information between the fiscal authorities and a mutual assistance between the authorities, which is fully comparable to what happens in form of cooperation between EU states. The idea is evidently that clause here goes back to the need for non-discrimination of foreigners, at least if these foreigners are EU citizens, and well, as it might have been complicated, and as also the free movement of capital is involved, if, let's say, US citizens invested in German houses or so, then you always have a non-discrimination principle of EU law. And so the best solution here seemed to be we grant that allowance to everybody, but it will be proportionally reduced, or it will be reduced, sorry, if the other authorities do not cooperate. Here, that makes really sense, because if you need to know if somewhere in the world these people have a claim to financial support which flows regularly in the future, then you cannot find that out and check that on your own as German authorities. So here you need an exchange of information and a cooperation with the other fiscal authorities, so that at least when the taxpayer has made wrong allegations, you have a chance to have that checked and have a slight chance to prove that there was a tax fraud attempted. So under that idea, this condition makes sense. Good. So if father dies and leaves behind a 10-year-old child, if now the child will get a monthly financial support from Social Security and some financial support from father's former employer, then we would ask first for the present value of these future benefits. Let's say they are 30,000. Now that would have which consequence? Under 17.2 number 2, the child would be entitled to an additional free allowance of 41,000 because it's 10-year-old. This allowance has, however, turned to be lowered by the present value of the future benefits, which you get for exactly that need. So only 11,000 free allowance would be left over. Okay, let's now talk about the inheritance tax in Germany concerning the rates. We have progressive rates. That is, well, clear or understandable. Seems to have some social idea in the background. If you, let's say, have parents from whom you inherit a ridiculous amount of, let's say, 1,000 euro, if the state came now and took away 50%, that would probably for you and every other person a kind of outrageous. On the other hand, if you have the lucky situation that you inherit 100 billion, if one then only takes 10%, because also the poorest members of the population would only get plundered with 10%, that would also be unconvincing. So progression is here the solution. The poor ones pay a small percentage. The very rich ones with the high inheritance taxes, the high inheritances or high gifts, pay huge percentages. And then the rates are further depending on the tax clauses. According to general public opinion, it's harsher to take away the inheritance which goes from parents to children than the inheritance which goes from somebody to some completely unrelated stranger, because there the idea is that completely unrelated person can still be lucky. Under the law, that person would probably have no claim at all. Only under the testament that person gets a claim, so that person can still be happy that something went to that person at all. One can debate about the question if such progression according to the family relationship is still adequate under today's circumstances, but it is a fact that in many states you can find such a variation of the rates, and in Germany you have it according to the tax clauses and the inherited amount. As we do not have one single tax rate, it's clear that the term is not tax rate but tax tariff. You remember, a set or a function, a list of tax rates for different cases is called a tax tariff. So the tax tariff is a term for the individual percentage which is the tax rate is the term for the individual percentage which is applied in a certain case, and the tax tariff is the name for the list. This list can be found in paragraph 19 of the Inheritance Tax Act, and here it is. Immediately here, the tax is levied according to the following table. Here you see, if somebody inherits, left column, value of taxable acquisition until or up to, first bracket, 0 to 75,000. So if somebody inherits 50,000, that's the relevant bracket up to 75,000. And if that is between father and son, that would be 7%. If it's uncle and niece, tax class 2, 15%. And if it's Mr. X and Mrs. Y, completely unrelated, 30%. So you see how the tax clauses, the tax rates increase with higher distance of the relationship. Important here is that the tax brackets are always up to. So if you inherit 301,000, you must never look at 300,000 bracket, but at the 600,000 bracket. Okay. You have to take into account here that the tax rate always is fixed here for the complete taxable amount. That can have interesting outcomes. For example, if somebody has a tax class 1 and inherits 74,900, the tax rate is 7%. If, on the other hand, that person inherits 75,100, the tax rate for the complete inheritance, according to the tax table, now jumps up to 11%. So that's bad. Enormous increase. 4% on everything are more because of these additional 200 euro. Naturally, that leads to very drastic increases in the tax amount. In the extreme case, even because of one additional euro which you inherit. Let's have a look. A inherits exactly 75,099 euro. You round that down to 75,000, and that is still the last euro amount where 7% is applied, so the tax is 525. Now B inherits 75,100 euro, so exactly 1 euro more. This remains after rounding down 75,100. This is already in the up to 300,000 bracket, and so 11% applies. The tax goes up to 11% on 75,100. That's 8,261. Now, as you can easily see here, 1 euro more leads to an additional tax of 7,736. 1 euro more, net property goes down by more than 7,000 euro. That's neither just nor fair. So that's entirely inadequate, and that has also been seen by the courts and by the law. And so for this reason, there is an inbuilt mechanism, a test, which says we need to mitigate this effect by capping that enormous additional increase of the tax caused by the last euros. This is laid down in 19.3 of the Inheritance Tax Act, and that tells us, well, that the difference between the tax which results from the tax table and the tax which is due at the last threshold, that this difference is only levied insofar as it usually can be paid out of half of the amount which exceeds the last threshold. Now, this is complicated, at least the wording. If you see how it's done, it's simple. In our previous example, that would mean, according to the tariff, the tax should be 8,261. Now, the threshold, the tax shall due to 19.3 not be higher than the tax which would have been due at the last bracket, the end of the last bracket, 7% on 75,000, that's 525, plus a maximum of 50% of the amount by which the last bracket has been exceeded. Here 75,100 minus 75,000, so 100 exceeds the last bracket threshold, and 50% of this is 50 euros. So the maximum, the floor or ceiling for the tax where it's capped is under that rule 525, tax at the last threshold, plus 50, 575. So the total tax is only 575 and not 8,261. Naturally, with increasing distance from the last bracket, the maximum amount gets higher and higher, so that after a certain while the limiting effect of that 19.3 cap expires or is phased out. Example 2, tax clause 1, son inherits from father an amount of 1.2 million. Personal allowance has to be deducted 400,000, we end up with 800,000. Forget about alimentation allowances, son is old enough. Children are usually old enough because the alimentation allowance is just a waste of time and too complicated. Well, so according to the tariff, 800,000 costs us 19%, 152,000 euro. Now we have to make the 19.3 test. The maximum of the tax which is really levied is the tax which would have been due at the last threshold, that's 15% tax rate on 600,000, so that would be 90,000, plus half of the distance which exceeds the last threshold. Last threshold was 600,000, we are at 800,000, so the difference is 200,000. Half of this is 100,000, so the maximum amount of tax which can really be collected in that case is 90,000 at the last threshold plus 100,000, so it's 190,000. The tax according to the tariff is 152,000. That's below the maximum, so the full 152,000 can be collected because the cap rule of 19.3 does not have effect here. Example 2, tax clause 2, inheritance is 400,000 between uncle and niece, free allowance for the niece 20,000, 380 is taxable amount, tax rate is in tax clause 2 25%, so in the up to 600,000 bracket, so 95,000 is the tax rate. The maximum for the tax amount is to be checked if that caps a bit of the 95,000, so tax at the last threshold would have been 20% only on 300,000, that's 60,000. And now let's look to the distance between the taxable amount, 380, and the last threshold, 300,000, so the difference is 80. half of it is 40,000, so it's not allowed to take more than 60,000 plus 440,000. So maximum for the tax which can really be collected is 100,000. As the tariff only demands 95,000, the tariff is already okay, will get uncorrected. So 95,000 can be taken. Example 4. Now the inheritance is 370,000, again uncle niece. Free allowance for the niece 20,000, so taxable 350,000. And now the tax would be 25%, so we have 87,500. The maximum tax amount is under 19.3, the 60,000 at the last threshold, plus half of the distance between the actual taxable amount and the last threshold. 350,000 minus 300, so the distance is 50, half of it is 25. So the maximum tax which can really be collected is 60 plus 25, 85,000. So here our tax officer, tax inspector, or whoever writes that tax notice would cap away a bit of the tax and say, okay, according to the tariff it's 87,500, but according to the cap rule of 19.3 it's legally kept or limited to 85,000 at maximum, so you only need to pay 85,000. Your tax is only 85,000 because this maximum is lower than the regular tax, and so it reduces it. Yeah, we had that already, so that's again that. A last remark has to be made still. In the middle, in 19.2, there is a rather theoretical clarification or rule, because they can find a hint that if a part of the total taxable property is exempted under a double taxation treaty, then you have to apply, in spite of that tax rate which would apply to total acquisition if everything were taxable. So that's the proviso safeguarding progression. The idea is, if somebody inherits 100 billion and 99.9 billion are tax-free, so that, let's say, 1 million or so only remains as taxable, then this is not a sufficient reason to let the tax rate also drop down. You know that from income taxation. The progression should take the total wealth of a person into the view. And so if there is a vast amount of property transferred, so that, let's say, a tax rate of 30% would be applicable, and now due to a double taxation treaty, most of it tax-free in Germany, then nevertheless the rate should remain the same. Now, we have already heard in the introductory lectures here, lessons, that this is in most cases mere theory, because first, Germany has very few double taxation treaties on the field of inheritance tax. Second, all the modern treaties never apply the exemption method. So the possibility that really a tax exemption under a double taxation treaty should occur is really, really very low. It's a very low probability. It might be that in cases of a double residence or so, or other things which are complicated consequences of a double taxation treaty, it might be that indeed Germany is precluded from levying a tax on the full worldwide property. I cannot really exclude the possibility. It might be imaginable, but it will be probably a very rare case. So should it ever occur that after a full test of the double taxation treaty situation in inheritance tax, you find out that a bit of the worldwide property of a person, although that person is unlimited tax liable in Germany, cannot be taxed, not at all, under German law, according to the rules of that treaty, then you would have nevertheless to apply the proviso safeguarding provision and take that exempted property into account when you calculate the total tax rates according to the tax rate table in 19.1. Naturally, as you study international taxation, you will keep especially that potential international or potential consequence of an international situation on the screen and remember it if it ever became relevant. Well, that was my remarks on the tax tariff and the rates and the personal allowances. We will still have to talk about some special constellations. We will also have to have a look at how we deal with that principle that we always take into consideration all the transfers within the last 10 years. All that is still to come in future small lessons. So enjoy that you have a small break again and wait together with me until this additional information will come in an additional video. Thanks for watching. Enjoy your time. See you soon here again back on the channel, and goodbye for this time.